Hello everyone, welcome back. In the previous video, we talked about financial analysis, whereby we study the company profitability, financial health, and dividend. We also look at the company business, whereby we study the company business model, economy mode, business risk, and growth drivers. The reason why we do financial analysis and business analysis is that we want to make sure the company we invest in is wonderful. As what Warren Buffett say, it's far better to buy a wonderful company at fair price than a fair company at wonderful price. So once we have identified a wonderful company by doing the financial analysis and business analysis, then we look at the company valuation. So why valuation? Because you can buy the best stock in the world, but if you buy it at a high premium, it's actually a bad investment. That's why valuation is very important. It's a huge part of the game. However, valuation is not black and white. It's an art. There's no single or perfect way to value stocks. So we need to be realistic when we value the stocks. So there are two valuation methods. The first one is what we call relative valuations, whereby we compare the value of the stocks based on multiples. The second valuation method is what we call absolute valuation, whereby we estimate the fair value of the company based upon its future cash flow or earnings or dividends, growth potential and risk. So for simplicity in this video, I will talk about relative valuation. Okay, there are many valuation multiples out there. The most common one is what we call price to earning ratio, or simply PE ratio. It is given by this equation, price per share over earnings per share. It measures how many years earnings it will take for the investor to recover the price paid for the shares. The other multiples is price to book ratio. It's given by this equation, price per share over book value per share. So price to book ratio is useful where the tangible assets are the source of value generation. For example, property developer, bank, insurance company, or conglomerates. Price to book ratio is very useful to measure the company valuation. Then we also have price to sales ratio. Sales ratio is useful when the company is loss-making, because the company earnings is negative, where PE ratio is no longer meaningful, or the company is distressing the earnings very much, where the profit margin is very low, then you use price to sales ratio. So price to sales ratio is given by this equation, price per share over the revenue per share. Then we also have price to operating cash flow ratio. So simply by dividing the price per share over the operating cash flow per share. It is a measure that deals with cash flow. The effects of depreciation and other non-cash factors are removed. So in my opinion, price to operating cash flow is more accurate representation of the company business operations as compared to using price to earning ratio. Because in the previous video, we also talked about earnings can be manipulated, but the cash flow is real. Then you also have dividend yield. So dividend yield is given by this equation. You divide the annual dividend per share over the price per share. So it is useful when the company is paying dividend, or simply the dividend payout ratio is more than the 50%. Then the dividend yield comparison becomes meaningful. So there are two ways to use the valuation multiple ratio. The first one be what we call historical multiple method, where we compare the latest valuation multiple to the past few years average. Ideally, we want to buy a company at lower valuation multiples as compared to the past few years average. So for this historical multiple method, we are actually comparing the same company, the current data, to the past data. Whereas industry multiple method, we compare the company's valuation multiples to the those of other company. So let's say you have a company A, B, C. You check which company has a lower valuation multiple, and the company has a lower valuation multiple is considered cheap. So allow me to illustrate more on PE ratio, price to earning ratio. So price to earning ratio theoretically means how many years earnings it will take for the investor to recover the price paid for the shares. So imagine there's a one company priced at $12 per share, and this company has no debt, but it has a very predictable income streams with earnings per share of $3. So theoretically, if the company pay all their earnings as a cash dividends, you can break even in less than 4 years. So generally, companies with lower P ratio are more attractive so long the P ratio is positive. For companies with the same P ratio, the one with faster growth rate in EPS is more attractive because it takes less numbers of years to reach higher earnings per share. Because P ratio is a function of two, the price and the earnings. For the earnings itself, there are two ways the earnings can be calculated. The first one is the TTM earnings, trailing 12 months earnings. So what happens is that we sum all the earnings per share over the past 12 months, and when we calculate the trailing P ratio, we simply use the price per share over the past 12 months earnings per shares. It is reliable because it is calculated based on the company actual performance. However, it does not take the future outlook into account. Then we also have forecast earnings, where we use the next 12 months earnings per share into the PE calculations. Because when you invest in the company, we invest based on the future rather than the past performance. So forecast earnings is sometimes more useful than the TTM earnings because it is based on the projection of the future. Then, how we calculate the intrinsic value of the company using PE ratio and TTM EPS? So there are three steps here. The first one, we need to find the average of the historical PE ratio for the past 5 or 10 years. Then we multiply that average by the latest 12 months EPS. Or if let's say you want to use forward EPS is also possible, then you will multiply that average P ratio by next 12 month EPS. Then once you have done the multiplication, add the net cash per share. Because by doing this, we are actually calculating the intrinsic enterprise value of the company. Let's go to our case study on micromechanics. Let's first find the historical average PE ratio. So you can find the average PE ratio from morningstar.com. So as you can see here, let me go to the Morningstar website here. So what you need to do here is you go to google.com and you type in the company name space Morningstar, and then you click on search. Then usually the first one in the list is the link to the morningstar.com. So click on that. Then and it will bring me to the morningstar.com micromechanics. Then what I need to do here is to go to the valuation here. Click on the valuation tab. Then here I will get the valuation multiple table. As you can see here, we get various valuation multiples here over the past 10 years. So what I am interested right now is the 5-year average PE ratio, which is 17.04 here, shown here. So I will take this value, 17.04, as a 5-year average in my calculation. And then what I need to do here, I will find the next 12 months EPS. So what will be the forecast next 12 month EPS value? So I will make use of marketscreener.com to find the forecast EPS. So what I do here is I go to marketscreener.com, I type in micromechanics, and then I go to the financials here. As you can see, the tab here, financials. Then I will get the forecast values for the next 3 years. So what I am really interested right now is the EPS for the next 3 years. As you can see here, the next 3 years EPS is shown in this row. So I'm looking for the next 12 month data, which is 0.13 or 13 cents. So I will take the 13 cents as my next 12 month EPS. Next, I will need to find the net cash per share of the company. So again, I will go back to the marketscreener.com, where I will need to find the net cash of the company. So as you can see here, under the balance sheet, then I will see the net cash position here, which is about $25 million for 2021. And then I will need to find the number of shares available, which is about 139 million. Then I will take these numbers, I will do a division, then to find the net cash per share. Simply I take the 25 million divided by 139 million, I will get the 18 shares for the company. So this company has a net cash per share of 18 cents. Then what I will do is to calculate the intrinsic enterprise value of the company. So earlier on I get a 5-year average, which is 17.04, multiplied by 13 cents plus 18 cents of the net cash per share. Then I will get the intrinsic value of the company about $2.40. So I will then compare the intrinsic value to the share price of the company. So ideally I want to buy the company at a price which is close to the intrinsic value or lower than the intrinsic value to give me a margin of safety. Then you can also use PB ratio to calculate the intrinsic value. So instead of using the PE ratio right here, then you use PB ratio, price to book ratio, then you multiply by the next 12 month book per share. And you can get also the intrinsic value of the company. So I hope today's sharing on the valuation is helpful, and I wish you happy investing. Thank you.